So how is option ticker label interpreted?
Okay, so when we see the strike price first of Nifty, it will be written as Nifty, that is the ticker symbol. It will be written as Nifty 21st April 2026 and the strike price. Now we will interpret what is strike price, what is the ticker symbol, and how to buy the option. So now we will see how this label ticker is interpreted. Here you can see it's written as Nifty 21st April 2026 24,150 CE. That is a call option label. So here you can see that Nifty is the underlying asset which is from which the option pricing is derived. If it would have been another stock, it would have been replaced by HDFC, Reliance, etc. But for this option it's for Nifty, so the first Nifty denotes that the option belongs to Nifty. After that, 21st April 2026, it gives the details about expiry of the contract. This contract will be expired on 21st of April 2026. Further return number 24,150 is the strike price of the option at which we are going to buy. And CE means call European. It's a call option in European style of options. There are two types of options, European and American. So this is a European type option. Based on the type of option, the expiry conditions also differ. Now, how to interpret this option? When we entered in this trade, the Nifty price was trading at 24,121. And her analysis was Nifty will move up from here. She selected this strike price of 24,150. According to this, the actual design of the contract is made such that if she feels that the option expiring on 21st of April 2026, the Nifty's price will be 24,150 on that day of expiry, she should select this option. If she feels that Nifty's price on the expiry day will be 24,200, she should select the strike price of 24,200. According to this, exchanges design standardized contracts of future and options. So Nifty has a 50 strike prices standardized contracts. One contract consists of 65 quantity, as you can see here. This is the standardized contract for Nifty. According to the strike price selected, it's classified as at the money, in the money, and out of the money. Depending on the type or moneyness of the option, its Greeks changes. Greeks are used to determine the option pricing. Here you can see the delta value of this option here and other gamma and vega values of option here. Based on these Greeks, the option pricing will differ. For example, delta of this option is 52. So what is delta? Delta measures the change in price of option with respect to change in price of the underlying asset. For example, if Nifty moves 100 points after purchase of this option, the premium of the option will move 52.69 points. That's what delta classifies. After that, theta value. Theta value is the value of the option and also called as time value. It shows that how the price of option will decrease as the time passes. So it's type of premium for time period. Gamma is the second order derivative of delta. It shows that what is the change of delta when the strike prices changes, at what rate delta changes. For example, if Nifty price goes to 24,200, this option strike price was out of the money call when purchased by Soumya. Now when the Nifty price will move above 24,200, automatically according to the mechanism, this strike price will move in the money. So while this movement is happening, what is the rate of change of delta? That will be determined by gamma. That's it. Vega is the volatility. Based on the volatility of the market, option prices differ. Higher the volatility, higher the premium. Lesser the volatility, lesser the premium.
Depending on the moneyness of the options, how we choose the strike price?
Okay. As I previously explained, strike prices depend upon the underlying price, and also the premium they are paid depends on the moneyness of the option. For example, if you feel that premium of the option is more as compared to your buying capacity, and you also feel that there is a less chance of market movement and you might lose premium, so you want to pay less premium, right? So generally, out of the money options have less premium as compared to at the money options and in the money options. If you find that you will face a risk of premium erosion, then you can go for out of the money options. it also translates to your conviction in your analysis. If you feel that the price movement will be immediate and you want a return as good as the price movement and also you want to pay less premium, you can go for at the money option. Second scenario, if you have high amount of conviction and also want the premium appreciation with relation to the underlying price, then you can go to in the money option. In the money options will have high premium, but also they will have high delta value. So if delta value is as good as 0.9, if Nifty increases by 100 points, in the money option will increase by 90 points. Considering at the money option, if delta of the at the money option is 0.5, if Nifty increases by 100 points, the at the money option will increase by 50 points. In case of out of the money options, the delta between the range 0.2 to 0.4. So if Nifty increases by 100 points, out of the money option will increase by 20 or 40 points. Now translating all this into the selection strategy, it totally depends on your risk appetite and your expectations and return expectations. Okay, if you want a higher amount of return, you have conviction in your analysis and also you have the ability to purchase high premium, then you can go to in the money options. If your conviction is good but still you are not in the capacity to pay high premiums, then you can go with at the money options. Second, if your conviction is not that good and also you don't want to pay high premium, you can go with out of the money options. This is the method we select options while trading based on the delta value and moneyness of the option.
Based on the moneyness of the options, how do you decide the risk to reward ratio basing on the strike price?
Okay, now we will see this while practically trading the underlying asset. How do we define the risk to reward ratio? For example, this is today's Nifty chart, 5-minute chart of Nifty, which is the underlying for the asset which we have chosen for trading. Now you can see here, if we decide to take trade on this candle, this specific red candle, based on our analysis, whatever may be the analysis, if we decide to choose the trade based on this candle, what is the buying point here? So we will buy at the close of this candle, okay? This will be our buying price, means executed in options. And then what stop loss should we keep? For example, we are using Fibonacci series and based on Fibonacci series we are constructing a stop loss. So this is the 50% level of the Fibonacci. It exactly translates to 24,367. Now I will mark a line here of 24,367. So blue line will be our buying point and red line will be our stop loss. Now we need to measure exactly how many points this stop loss is. So by using the measuring tool, price range tool, we can measure this stop loss. So the stop loss is 68.25 points. Now we will calculate the stop loss and risk reward based on the option price which we are choosing. Now here the trading price is 24,297, roughly 24,300. Here 24,300 call will be at the money because it is closer to the underlying asset price. Okay, so this will be the at the money. Now suppose you decided to buy the at the money call. It will be the at the money call of 24,300 strike price. So approximately the delta value for at the money calls is around 0.5 approximately. So now you calculated this and you set a target for around 120 points, somewhat around here, 24,117. Okay, now depending on delta, your risk will be 68.25 into 0.5 will be a risk for that option. Okay, because delta of that option is 0.5. So 68 point stop loss into 0.5 will be the stop loss for your option. Means it will be roughly 34 point stop loss in an option premium. If the option premium gets eroded by 34 points, you will exit the position. And your target will be 120.5 into 5. that is 60 rupees. When your option appreciates by 60 rupees, we'll exit the option. This is how we calculate a risk to reward based on the moneyness of option. We will take another two scenarios. Now if you decided to choose the in the money option for this trade, so in the money options will be strike prices below 24,300, 24,250, 24,200. These will be the strike prices of in the money. So we will select strike prices. So for in the money, the delta value is around 0.8 to 0.7. Okay. So while trading here, if you try to trade put based on this trade, if your price depreciates 120 points, your put in the money put will be giving you 120 into 0.8 returns. That will be around 96 points. So for put option, your returns will be 96 points. And your risk here will be 68 into 0.8 again. It will translate to roughly around 54 points. So 54 points risk and 96 points reward. This is how we calculate risk to reward based on option in the money option and out of the money.
Looking at the Nifty candlesticks here, there is a consolidation phase. What would be your decision in this zone? Like, how would you explain that?
So based on the box pattern, we can interpret this. Generally, there is a pattern called box pattern. So when the underlying asset or any instrument goes in the consolidation phase, we define the phase in which it was consolidating. So here if we draw a box, we come to know that this was consolidating on a price range of 24,328 to 24,264. So the method to trade this box pattern is, we measure this box pattern, and when the stock breaks out, we take exactly the same target as the length of the box. So when we put this here, our target translates to 24,196. So we will enter on the breakout of the box on this candle. Price of entry will be 24,254. It's visible here. When you see, it's visible here. 24,254. Based on this, we will keep our target as 24,196, and our stop loss will be above this box, that is 24,330. This is the method to trade the market when it is coming out of a consolidation phase. If market shows a clear box pattern, just mark it, measure it, and keep same as the stop loss and target, which will fetch you a risk to reward of 1:1.